In the currency quadrant, taking a look at the September Japanese yen future, which just rallied two consecutive sessions for the first time since June 3rd and June 4th. And this two-day rally far outperformed that one. The June 3rd and 4th double equaled a move of more than 1.62%, and the last 2 days, the yen has jumped 2.32%. The high today, 64.17, was plus 0.86% from yesterday's settlement of 63.62, and the low today, 63.31, was down almost 0.5% from yesterday's settlement. At the New York close today, we're still up right around 0.49%, and on a weekly basis, the yen completed its first up week in the previous 4 and only its fourth up week in the last 10. Short covering is part of the reason we're rallying so abruptly and with so much respectable volume. The spike in volume we've seen implies the short covering in and of itself when you look at the downtrend the yen has been in. Preliminary volume this week in the yen was nearly double last week's and was the largest total volume since the week of June 10th, which makes sense considering the yen hit a 38-year low on June 10th, or I should say during the week of June 10th. The timing of the short covering seems to make sense considering the probability of rate cuts in the US has gotten much higher. The CME Fed Watch tool is now pricing in an 88.1% chance of a 25 basis point rate cut in September. Just a month ago, it was about a 51% chance. And it's also pricing in 6 rate cuts by July of 2025. And all of that should weaken the dollar unless all the other central banks cut rates more aggressively than that. And that's not something Japan is going to be doing. They may not be raising rates, but they're certainly not talking about cutting rates, at least not at this point. So all of that seems to be a short-term tailwind for the yen.